Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to be going over the recent Producer Price Index report for July 2022. I apologize for the delay on this, but I was waiting for the update from EIA.gov to get the latest gas prices to figure into my final demand model. I'll get to that in a few minutes, but first off, let's cover what happened in the producer prices on the aggregate, then drill down into the details, and then finally project out for the Consumer Price Index report for next month. So all commodities, we saw a sharp decline in the producer price index. This was something that I predicted would happen because I had noticed this on the commodity index tracking funds back in middle of June. So I was kind of shocked that we didn't really see this much on the June report, but we did start to see the decline in the July report. And you can see here that month over month, the commodity prices dropped by 3.1%. From a year ago, they have dropped from their peak of 23% down to 17%. And it looks like that based off of this crunch in the commodity prices, this drop will continue on into several months. Because these commodities, this measure of commodities is still measuring intermediate demand. It's not really measuring completely raw materials and everything. It's earlier stages of production, yes. But it doesn't. I don't think it takes into account raw material commodity prices, and I wish that it would. But from what I can tell, these are the beginning stages of intermediate goods. They're just commodity prices on that stage of production. Looking at final demand, the final demand number contracted by 0.5%, so we actually had a drop in final demand. Annualized, this brings down the annual inflation number for final demand from 11.2 to 9.7. That's bringing it much closer in line with the annual CPI. That contracted from 9.1 in June to 8.5. So there's some of that difference in variance is beginning to vanish as we're seeing this contraction in final demand. However, much like what we saw in the CPI, the final demand, what was driving and bringing those prices down was energy. So when we strip out energy prices out of final demand, we actually do have a slight increase in the final demand prices of 0.2%, but compared to past months, this is very, very subdued, and we'd have to go all the way back to 2020 to see any month more subdued than this. From a year-over-year basis, this does bring down final demand prices, stripping out energy prices, down to about 8%. So that's certainly a good sign there that we're seeing this decline in core final demand, still keeping in food prices, which are increasing still very strongly. When we take a look at the categories, we can see here that when we're looking at foods, final demand foods increased by 1%. And this is part of a goods category that had a sharp decrease by 1.8%. So foods are still going up. This aggregate number is, of course, all of final demand. And in order to figure out where that is, we just need to go down to final demand energy. So once we go down to these energy prices, we see a sharp contraction of negative 9%, mirroring what we saw in the CPI. And of course, this is going into the major components of gasoline and oil, and there is some in natural gas. One thing I do want to go into is when we take a look at processed goods, we see a bigger drop in this. So the earlier stages of production, we're seeing a sharper increase, negative 2% for processed goods. Again, this is more linked to fuel. So when we take a look at natural gas and we take a look at gasoline, again, we're seeing these sharp drops here, and also what's used in utilities. So those types of fuels are showing that sharp contraction. That's certainly good, but that seems to be where the concentration is. When we look at unprocessed goods for intermediate demand, so we're really going up the upstream here. Look at this drop, month over month change of negative 12% here. Huge, huge drop. And one interesting point is that we saw this huge drop in wheat, a welcome sign there that we're seeing a drop in wheat there. Unfortunately, we're seeing increases in other categories. For example, for the prices of slaughtered pigs increased by 23%. So there's still a lot of variance that's going on in here. Yet again, though, the biggest contributor to this is obviously fuel products. So when we take a look at crude oil and a big drop in natural gas, these unprocessed goods, so the earliest stages of intermediate demand, is where this sharp drop is, and this indicates that we'll most likely see continuing drops in later stages of price indices, so later stage final demand and then in the consumer price index for months to come, as I was foreseeing here. The big part of this has to do with the Biden administration releasing millions upon millions of barrels of oil. And they've been doing this. They really started ramping this up in obviously late stage of 2021, and then obviously speeding it up in 2022. But they've sold off at least 200 million barrels of oil, almost a third of the U.S. Oil supply in the Strategic Petroleum Reserve, in order to depress record high gas prices. And that's having an effect on retail sales for gasoline prices, which, as I've noted, is feeding into very closely with the CPI, as CPI takes into account those gasoline energy prices very quickly. So once I was able to account for this in my final demand model, I'm noticing much less variances over time between that and final demand prices. Looking ahead for next month, factoring in these record low fuel costs and the dismal producer price, the good news, low increases in final demand absent of energy, it is pointing to a contraction in the consumer price index of about negative 0.8%, or an annual rate of inflation dropping to 7.3%. That's very key that we're beginning to see these drops. So peak inflation is looking like it to be here, at least for some time. But again, I want to stress that this has to do with the artificial deflation of gas prices caused by artificial increases in oil supply from the Biden administration releasing the Strategic Petroleum Oil Reserve. Once this expires in October, it's unknown whether that will continue to have an effect. Most likely, we will see gas prices level out, but also I would say that there's a strong probability that we'll see a resumption in oil price inflation, as the core problems that was causing that rising inflation have not been mitigated and eliminated yet. So we'll probably see some pushback. We could even see a snapback in inflation sharply increasing from sharply rising energy prices, and unfortunately there won't be much ammo left in the Strategic Petroleum Oil Reserve to keep that depressed. Does that mean that we're going to see gas prices head back up to $5 a gallon? Unknown at this point. My guess, though, is that we'll most likely see gas prices surge well over $4 a gallon by the end of the year, and we'll see a resumption of energy price increases. But to keep things in note here, we're seeing an unusual situation happen in the money supply. So when I pull up the M2 numbers, and of course I've captured this on previous videos, but I just want to reiterate, we are seeing a flatlining in the money supply. This is unprecedented that we're seeing a flatlining for this long. We have not seen a flatline this long in the money supply really since its inception. Something extremely unusual is going on. My guess is that it has to do with the relatively strong dollar, as well as the general treasury account taxing money out of bank accounts and then becoming more slow to spend money. But with the recent passage of the Biden administration's spending bills that will most likely increase government spending, that's got to tap into bank reserves. And once it taps into those bank reserves, then it will resume an increase in the money supply. On the other hand, though, we are still seeing debt numbers go up and up and up. So when I pull up the total debt for the United States, and let me pull that up right quick, debt securities and loans. We're still seeing it quarter after quarter after quarter of sharp increases in debt. This is the sharpest increase that we've seen in debt since probably the 1990s and early 2000s. We were seeing a little bit slower slope increase. You probably can't really see this on this absolute curve, but if I show you the percentage change from a year ago, you can see how we're seeing this upward changing percentage increase year over year in total debt. And of course, here's a huge bump in total debt that we saw in 2020 and the early parts of 2021, which caused the initial bout of inflation. We've seen this relative drop in debt growth, along with a flatlining money supply, combined with the Biden administration releasing record amounts of oil, that's beginning to depress these consumer prices. But this debt growth is still on an upward trend. If that continues, we will most likely see a resumption of inflation sometime in the late quarters, okay? So looking ahead, as far as the CPI is concerned, my guess is that we will see we will see a contraction in the CPI of, hang on one second, let me put this in, of negative 0.8%, and then we'll probably see some leveling out for the rest of the year. So my guess now is that, and looking at the outward projection, is that the CPI is going to drop down to 7% year over year. It may even drop below that in October, but we'll see how that transpires and what happens if gas prices continue to go down or if they just start leveling off because of that increase in supply as the markets have basically compensated for that. So very interesting stuff that's going on. Unfortunately, it doesn't look like it's sustainable at this point because, again, the major component here has been this fuel prices. So fuel prices are dropping now at record pace. They're looking to drop at over twice the pace that they did last month. That's the reason why I'm looking forward into my final demand model to show that we'll most likely see a contraction in the CPI. That's good news, but it's most likely going to be concentrated on energy. We might see some drops in food later on down the line. We'll see how that transpires. Anyways, guys, that's all that I have for this video. If you like the content that I provide, make sure that you drop a like button, show me some support, let me know what you think about all of this, drop me a comment, or just comment on the data that I have provided. And as always, make sure that you subscribe to my channel, click that notification bell so you're always keeping up to date with the latest videos that I provide. My next video will be a continuation of the tutorial video that I produced last week, and I'll probably get to that in the next couple of days. Once again, guys, I thank you for watching this video, and I'll talk to you next time.